Good day, all. Michael Williams, broker owner, Global Realty Group, out of Carson, California. DRE license number 01468935. Today, I'm going to talk very briefly about depreciation. Now, I always give a disclaimer when talking about tax related topics that I am not a tax attorney or a CPA, so any viewers should consult with their tax professional if they have any questions. So, depreciation is the topic today, and it'll be the first in a series of commercial topics that we will have on Global RE TV, available on social media, on our YouTube channel, and the many social media outlets such as Instagram, and then there will be a feed for the other outlets as well. So, in terms of depreciation, when an investor purchases a property, the cost of the building and the land are capitalized. Now, not to be confused with the depreciation of the building or the structure itself. The land is not depreciated, but land and structure are capitalized. So, the cost of a building that is used in the trade, such as a rental property, and that product type of commercial real estate is depreciated using the standard formula, which is the value of the asset multiplied by 85% and then divided by 27.5 years. Now, for other product types in commercial real estate, that is office, warehouse, industrial, and retail properties, then that is depreciated using a 39-year criteria. So, one thing that we offer at the Global Realty Group commercial division is, and it's a free service that we provide to our clients, is a seller's annual operating statement of return. This is very important for real estate investors to obtain because real estate, and especially commercial real estate, deals primarily with the numbers. So you want to be sure that you have those numbers, in line to see what your return is, because that's the key in terms of your investment. So what we do initially is we look at the total property revenue, and that would be all of the rents collected, and also to include any late fees, fines, laundry income, revenue brought in by garages, or any revenue, and you take the total gross income, and what we put into a category called the scheduled gross income, and that is basically the SGI. Now, there are two factors that get deducted from the scheduled gross income that allows to come up with a sum, which is obviously the net operating income. And one factor that is deducted, of course, is a vacancy factor. Many investors believe that if they don't have any vacancies, or they haven't had any vacancies in some time, then they should put zero in terms of that. But when you view the numbers, and when you put together, or a real estate professional or broker puts together a statement of return, we always view the asset from the perspective of the lender. And the lender's standards in terms of their vacancy factor is usually based on the density in the area where the asset is geographically located. So here in Los Angeles County, we are a high density populated area as opposed to other areas. So therefore, a vacancy factor would be 5%. So you would take the SGI multiplied by the 5% and then deduct that amount from the SGI to come up with your effective gross income, or your gross operating income, or the GOI. The GOI then is used, or used in terms of the next factor, which is expenses. And the expense factor in terms of most lenders is 35%. Now, if the expenses are more than 35%, then you would use that number. But if it's less or at 35, you use 35%. So vacancy and expense factors would total 40% deduction from your scheduled gross income to come up with your net operating income. The next factor in all of this, of course, if you have a loan on your building, there's a loan on the building amortized over 30 years and then broken down to an annual payment, principal and taxes, to determine your debt service. NOI minus your debt service produces your pre-tax cash flow. That's pre-tax cash flow. Well, you would ask, how is your after-tax cash flow determined? Well, then you take your scheduled gross income, or your gross operating income, and deduct your annual interest on your loan. You deduct expenses. Then you would deduct your appreciation, which we just went over, to come up with your taxable loss. Then your tax bracket is considered. With most, it can be anywhere between 25 and maybe even up to 35%, depending on the client and where they fit in terms of their income. So your tax bracket then is calculated and deducted from the taxable loss to come up with the key, which is the taxes payable. Then your taxes payable, once you have that number and figure established, you would then look at your appreciation over this past year, your annual appreciation, and you would add that figure to your taxes payable, and then you would come up then with your annual return on your statement there. So these are very important for investors. When an investor purchases a new property, they're in essence resetting their depreciation. The downside to selling an asset as opposed to exchanging it, of course, is the taxable gain and depreciation. So these are very important factors that you have to consider when dealing with commercial real estate, because depreciation reduces your adjusted basis. So when an asset is sold, any gain is more because the basis is lower due to depreciation. Now, there are some passive active losses or activity losses that are not deductible or not fully deductible until the rental property is sold. So some of that can be offset when the property is sold. So depreciation recapture is another big part of all of this. And when you sell a property, 25% of the actual gain is taxable. 25% of your gain, so your depreciation. But over time, your depreciation reduces. So if you hold on to a property for more than 7 years or so, then you'll start to see that depreciation lower. And then in some instances, even in a shorter amount of time than that. So the other factor is if the property is somehow sold at a loss, then the depreciation recapture does not apply. You would just report the loss. So that'll be it for today's segment on depreciation, just a brief overview of our seller's annual operating return statement. If you care to receive more information, you can visit us on the web at www.globalregroup.net. Please download our property search app at Global Realty Group from the App Store or from Google Play. Our office address, 637 East Albertoni in Carson, California. We're in Suite 111. And our phone number, 310-538-6884. We look forward to talking to you, and make sure that you have a happy and healthy and prosperous 2019.